I want to get reaction right now on today's jobs report. For that, I want to bring in Joe Brusuelas, chief economist at RSM. Joe is here at the New York Stock Exchange. All right, Joe, this number, 22,000, that's weak. There's no arguing it. And this time, that lines up in terms of weakness, not the exact number, with ADP. What does that tell you about the state of the job market now?
We've got a problem on the demand side, and we've got a problem on the supply side. We've got cyclical factors driving down demand, pervasive uncertainty around trade and immigration, in addition to basically lackluster consumer spending. You know, you inflation adjust consumer spending, it's at 1% on a 3-month average annualized basis. When you get numbers like that, hiring slows. Then there's the supply side. It's a structural demographic factor. 11,000 baby boomers are retiring a day.
Yeah.
So we've got a really second straight bad job report here. Moreover, downward revision of 21,000 over the past 2 months. That means a change in total employment of 1,000. The unemployment rate moved up to 4.324, which means we had a near miss of it moving to 4.4. Moreover, as you dig down into the data, if it wasn't for private education and healthcare, we'd have a big fat negative sign across the board here. That's why equities are up, because good news on Main Street, or excuse me, bad news on Main Street is good news on Wall Street.
I know.
We're going to get that 25 basis point cut now.
Now, the question is, will it be more than that? And before you dig into that, the revision stood out to me as well. June revised down by 27,000, right, to a loss of 13,000 for June. July was revised up slightly, but just by 6,000. So we're talking 79,000 for that month. So, you know, the revisions, it's just, as you mentioned, lower than what was reported. It makes the Fed, who were those who were seen as outliers, stand out more now for their cries, their calls previously about doing a rate cut sooner. Do you feel like the Fed is too late now, or were their hands tied?
No, I don't think that they're too late. We're going to get the cut. There really is no big difference between a July and a September 25 basis point cut in September and one in July. The point here is that members on the Fed, such as Christopher Waller, who's openly running to be the Fed chair, so he's playing to a different consistency, but he's willing to cut into rising inflation. In terms of, should we get a 50 basis point cut?
Yes.
Okay, now
that's the question, because I was talking to an economist yesterday, and he said if it comes in much weaker than expected, you can see the odds increase. And I haven't had a chance to check the CME Fed Watch tool. Let me check that really quickly and see where we stand right now. 99%. So that economist's point was, if we saw it tip over 100%, which I didn't even know it could, that then I did not know that, that then you could get the odds for a jumbo cut.
The market's not pricing in a jumbo cut for one very good reason. Inflation's going the wrong way. We would need to see a massive downside surprise to next week's CPI report for the Fed to be comfortable with a jumbo-sized 50 basis point rate cut. You know, this is really important. You guys out there in investment, finance, and economics land understand that low interest rates, leverage, and liquidity are the holy trinity of our business. Main Street doesn't understand that, and this is the sort of thing that will get Main Street's attention, right? For the last year, the problem hasn't really been the labor market per se. It's people are having a hard time finding a new job if they get layoffs. Remember, we have 2.5 million people hired, 2.5 million people fired every single month. The labor churn in the U.S. is nothing short of dynamic, right? But now what we're seeing is that labor demand is just slowed, but that decrease in labor supply is actually masking the unemployment rate. We did a real fun exercise yesterday where I looked at the labor force participation rate. If I held it steady to where it was in 2023 and 2024, the unemployment rate wouldn't have been 4.2 pre-report. It would have been 4.85. A very different situation, right? So this is a really difficult judgment call over at the Fed that has to ascertain where the economy is, it's slowing, where labor demand is, well, it's slowing, where labor supply is, it's falling, which makes this really difficult given inflation's going up. But nevertheless, my models say we shouldn't cut, but we're going to get one.
Okay, so I mean, to me, this is, underscores the view and the conviction that we should get one from these reports for September at least. Maybe not the 3 that the market is perceiving for the rest of the year. But let me ask you this. So, you did still see some strength in healthcare. But it's below the average monthly gain over the past year. What does that tell you about? Is there still some pockets where you can see growth or opportunity, if you will?
We've got an aging society. Demand for healthcare is going to be solid to robust indefinitely. We need to add 50,000 jobs every month to keep the employment conditions stable. It's very clear over the last 3 months that hasn't happened. Now, when we regather next month, this number is going to be revised up because we have all kinds of problems in August, seasonally adjusting this, primarily due to the vacation and back to school schedule.
Okay.
That's why June and August are real crapshoots when it comes to this. I had a 45,000 forecast. I missed it to the upside, yet I was so far below the consensus. People were calling and saying, hey, what is it you know that we don't? I don't know anything that we don't. It's just that August is very problematic.
Okay.
And the last 3 months tell me that we've added 27,000 jobs per month over the past 90 days. And it's now appropriate that the Fed put in an insurance risk cut. And then we can see where we're at in October and then again in December. Because let me tell you, that inflation number is not going to be making a U-turn anytime soon.
Oh, because of tariffs.
That's right.
Yeah. Let me ask you this. So, one of the things that Neela Richardson pointed out about ADP, chief economist, about some of the weakness that we've seen recently, one of the 3 things she pegged it to was AI disruption, and we did expect to see some of that. But then there was the view, you remember Shauna Smith, who had this view that AI would be a jobs, in the beginning stages, would add jobs to the economy. What's your view? Is AI a disruptor and, jobs taker, if you will?
I think AI is a little bit like trade. We're all going to be better off, but the distributions are going to be unequally shared, meaning Eric Brynjolfsson, who's the brilliant professor out at Stanford, has put together a series of papers, including a recent one, that does suggest there is some disruption for entry-level workers. However, for those who can master some of this, who can augment their skill sets, the sky's the limit. Little like 10 years ago when we started seeing cloud engineer posts. Okay, the BLS didn't even have a NAICS code for that. Yet it was the hottest job here in New York, down the street at Google, right?
And could get paid very well.
Yeah, and we've got evidence right now of young people who've got good econometric skills, good machine learning skills, are making $250,000 and they're not even 30.
Which is wild.
Well, that's the way of
for
things,
that
isn't
for
it?
that age.
Yeah.
I know. I mean, do they even know what to do with it? I suppose going out and whatnot.
That's a different question.
Yes. Okay. So as we get into the last few months of the year, so you do make a great point about how August can be. Do you expect us to regain some momentum in the job market, or does this tell us that we should expect softness through the balance of the year?
Okay.
Especially the point about baby boomers you made earlier.
My sense is that we're going to grow at around 1.1% this year, right? But I am expecting an acceleration based off 3 things: the rate cuts, the tax cuts, and don't underestimate the role that's going to be played by full expensing of investment. And I think we'll take off later this year, but you'll see it most visibly in the first and second quarters of next year.
Okay, all right, that's the word there. Thank you, Joe. Always great insight. That's Joe Brusuelas, Chief Economist, RSM.